economy in general, and something that really affects all of us, because if we can't heat our houses, if we can't find enough energy to run our cars, if we can't find also agricultural resources like wheat, if we can't eat, all that will affect us. And I'm going to take a very broad overview and a broad discussion on commodities here today. I'm going to focus on natural resources. My background, as Martin just said, is on the mining and on the exploration side. I'm not an expert on the agricultural resources. And want to take a deep dive into what it actually means to look at commodities, to look at wind energy, to look at solar panels. As you can see here on this picture, for example, it's very easy to say we're getting out of oil. We don't want CO2 emissions anymore, and instead of that, we want wind turbines and solar cells. And we're going to have a look at what this actually means in terms of resources and commodities in order to supply the world in these days with these commodities. A short structure of the presentation as I have it today. We go first looking at the energy transition and the energy security, some of the technical foundations that we have. We look at industrial metals and oil, sustainability in the mining industry, gold, and then we take an outlook. Anybody who looks at commodities and energy supply in terms of the energy transition needs to understand that we're having here an industrial revolution. It's a revolution which can be compared to the introduction of the combustion engine at the beginning of the industrial revolution, beginning of the 19th century or the end of the 19th centuries, the introduction of the of cars and combustion engines. Sorry, one step back. I mean, of course, the steam engine at the beginning of the Industrial Revolution, or the combustion engine end of the 19th century, or the PC in the 60s and 70s, and so on. Because we really have here a revolution which is taking us away from burning fossil fuels, burning oil, coal, and gas, into generating energy on a with non-fossil source, and then actually creating a currency. And this currency, the electricity, needs to be conducted. And the problem is here that we only have really a limited amount of metals and resources that can help us to generate this. I've put on this table here on the right-hand side, which really nicely summarizes what this is about. If you look at the conductivity of metals, and this is really the crux of energy security and the energy transition, there are only really 4 metals that really can conduct electricity. And from the top here, that's silver. Of all the metals, silver is the metal that. Sorry, can you see my cursor, Martin? Can you quickly indicate to me whether my cursor is visible?
Yes. Yes.
Yeah, is it? Okay. So you see silver here, which is the metal with the best conductivity, followed by copper, then by gold. And this, you see the numbers here, that's the conductivity is measured in sigma, that's Siemens per meter. It's a physical dimension. So we have silver, copper, gold, 4.52, and then aluminium. It's also shown here iron. Some people might think iron is a good conductor. It is not. Iron is not suitable to conduct electricity, not in these applications that we need here. So of course you can't use silver and gold to use for big cables, would be stolen within a few hours probably that are installed, much too expensive anyway. This leaves us with 2 industrial metals really to conduct electricity, and that's copper and that's aluminium. Now the problem is that aluminium only has around 60% of the conductivity of copper. And that means, for example, in a coil that you need for an electric engine, you can't use aluminium. A coil that you need for example, in a wind turbine, you will have to go for copper. And that's shown here quite nicely. That's a section through a wind turbine. Wind turbine is nothing else than a big generator. The movement comes from that wind turbine here. Then it's getting through a gearbox, it's getting transmitted into this coil. You see a section through such a copper coil here on the left-hand side. And then that is sitting on top of a magnet. If you, the physics behind is if you move a conductor across a magnetic field that is supplied by that magnet that this coil is sitting on, you generate a currency. And then this currency is getting transmitted over to the end user, going to transformation stations and so on. You can't get away from this copper coil. And this, the reason is that due to the lower conductivity of aluminium, there's no other metal you could use for wind turbine or any other engine. The aluminium cables would be much thicker. You also need to consider there has to be insulation across these conductors, or the cable would be much too thick. And this is that's an indication that copper is the new oil for the energy transition and for all future supplies that don't use fossil fuels. We can't get away from copper. It's now nothing else. On transmission cables over long distances, you use aluminium. Very often there's a copper core in these cables, but not if you have a coil. By the way, this also comes true for smaller engines like a Tesla engine, for example. A Tesla engine or any other electric vehicle uses electric engines which are running on these coils. And that's something to remember. Now, this is only one application that we have for in the energy transition, but there are many other commodities that we're going to use. And of course, the Ukraine crisis, which is on our radars, all our radar screens in the moment, has created a totally new dependence on where these commodities are coming from. I have here, for example, on the left-hand side, you see these blue bars. That's the export value to Europe in billion US dollars. And on the right-hand side, you see how many percent, what's the size and percentage of these commodities are coming from Russia to Europe. And you see on the left-hand side, gas, for example, is 60%. Crude oil is 30%. These are the dots that you see here. Yeah? So that's the dots are relating to the right-hand scale, the bars, the blue bars to the left-hand scale. Diesel and gas oil is around 15%. Thermal coal, over 20%. Met coal. Refined nickel. This is something we're going to look later in detail, because refined nickel, apart from copper, is one of the really important metals we need for the energy transition. We need for example, for electric cars, but we also need it for steel. You need nickel in order to produce steel. Aluminium, 10%, iron ore, 10%, finished steel, also just under 10%. The one metal that's not on here is palladium. And palladium in Urals nickel is one of the biggest palladium producers, probably as a single mine. It's the biggest producers in the world. You see here the orange bars on the right-hand side. That's in 1,000 ounces. So this would be 2 million ounces, 3 million ounces. And you see that more than a third of the palladium in the world has been produced or is produced by Russia. The rest, the big balance, is coming from South Africa. The biggest platinum palladium deposits in the world are sitting in South Africa. I just came back last week. I've spent 1 week on the South African platinum palladium mine to see where we can actually get the substitution from once Russia is falling away. And you need palladium for catalysts, in cars, especially also in diesel engines, partly also in combustion engines. So here we got a problem of substitution, and where's the material coming from? And this leads us to industrial metals and where's the substitution coming from? Copper, I've mentioned that already, is probably the new oil. Copper is something we can't do about, and it's easy to say, oh, when copper prices are going too high, we just substitute it. You see here on the left-hand side, you see the possibility how much can be substituted And on the horizontal axis at the bottom, you see the growth that we have. And of course, these new technologies that we need now here on the top right-hand side, power cables, building wire, electromotors, induction tubes, and so on, they are going through a very high growth phase. We're going to see huge growth over the next years with no chance of substitution, really. A plumbing tube on the left-hand side, copper is still partly used in plumbing tubes. There, of course, we can take polyethylene, for example, we can use plastics. Winding wire in transformers, where we have big transformers, really stationary big transformers, we could use aluminum cables here. There are some pilot studies done. To my knowledge, there is no commercial use yet of transformers with aluminum cables. I might be wrong here, but at this stage, I haven't heard any examples of that. But here's theoretically in stationary big transformers, there could be a chance to substitute copper with aluminum. Otherwise, it's becoming very, very difficult. Of course, data cables can be substituted by glass fibers. Yeah, you can data, you can actually communicate, you can send through glass fibers, but not electricity. If you look at the historic change in copper demand on the right-hand side here, there are two big drivers apart from the energy transition and this new technology. That's population growth. If population grows, more people want to use air conditioners, more people want to get electricity and so on. That's the one thing that's growing, that's in percentage growth per year that we have in these decades that are shown here. And the other thing that's being driven by new technologies is via penetration. Yeah, and that's now, of course, we're just at the beginning of this energy transition. This gray area, the gray part of these bars, will accelerate in the next years. If we're serious about energy transition, if we are serious of supplying more energy to the world, the penetration due to new technologies will increase significantly. That's shown here on the right-hand side in that bar. That's in the current decade that we're in, E stands for estimate. So it's getting tight a little bit, but the question is now energy. Energy is probably at the core of the primary resource that we need to cover. And what we have here, I want to focus first on the right-hand slide. And this is perhaps the most important slide in the whole presentation, because it shows how the energy use is changing in terms of the GDP per capita. So what you have here on the horizontal scale is the GDP per capita expressed in US dollars per person. So we have, for example, the United States here, $50,000 per person per capita. Germany is sitting here between 40 and 45,000. Russia would be here. And before we go to China and India, on the left-hand side, you have the energy use in tons of oil equivalent per capita. That means the energy that a person needs per year that is contained in a ton of oil. And it doesn't say here whether it's gas or coal or oil or whether it's already renewable energy, but the United States are here with a GDP of 50,000 uses per year, per head, 7 tons of oil. The energy content that's in 7 tons of oil. Germany sitting down here, sitting at 4 tons of oil, and so on. So the regression here, there are some outliers, is quite clear what we see. And you might now, especially in Europe, we want to get down now. Germany, for example, very strong ESG programs, especially now with the Greens being a part of the government. We want to get, or Germany wants to get down from 4 tons down to 3 tons. Huge efforts being here, but you can see from the whole situation, from the global situation, the big drivers in the future are China and India. The diameter of these bubbles is the population. You see that here on the right-hand side in billion people. Now, what's driving energy demand in the next years are these developing countries like China, India. And China now currently sits around $10,000 per capita, that's the GDP, and uses 2 tons of oil. I can remember very clearly when I started our company back in 2006, China was sitting at $4,500 per capita and was using 1 ton per oil. So over the last 16 years, India moved from here 1 ton to 2. China moved from 1 ton to 2 tons. India is sitting now here at 5, I think it's just under $5,000 per capita, and moved from around half a ton of oil per capita to 1 ton. And you might say, yeah, 1 ton or half ton is not so much, but you multiply that with 1 billion people. So these are the drivers in the future that's going to drive the global oil demand. And don't be under any illusion that it's going to be very, very tough to find this energy. And then what we are saying, we all want the energy transition. We all want wind turbines. We're going to need solar cells. We want Teslas. We want electric cars. But we're going to stay dependent on fossil fuels for many, many years. Currently, over 80% of the fuel of the energy demand is coming still from fossil fuels. There's still the addition of nuclear energy. On top of that, bioenergy, wood is still in developing countries a big contributor to energy. But in general, we're going to stay dependent on fossil fuels. And the general problem we have in commodities, and that's our specialty that we come from the commodity sector, is that we are basically running out of every resource that we need, whether it's burning or finding energy, or whether it's finding the metals for the energy transition. That's quite nicely shown here, I think, on the left-hand side. That's for oil. And that's the success rate in drilling in exploration, so-called wildcats. That's the development between 2011 and 2012. And you see that despite the increased expenditure that we have here, the wellbore count, actually the success rate, is coming down drastically here. And that's the dynamics that we find also in other commodities, whether it's copper or whether it's iron ore and so on. So the low-hanging fruit basically have been picked, but at the same time, we're going to see in the next year higher energy demand. So let's hope that we're getting the energy transition right. But the problem is that also on copper, we just saw copper is the new oil. On the right-hand side, you can easily calculate here that over the next 30 years, the copper demand will be more than the whole human history up to now. We're going to use over the next 30 years more copper than we all put together we have used. And the reason for that is firstly the population growth. So population growth, we're currently sitting at around 1.1% population growth per year. On top of that, we have the additional technology that we need. And if you add all that together, quite honestly, I think you see that this curve is actually flattening in this study by the United States Geological Survey, has been presented in a presentation by King Cora Copper. I believe that we actually see this curve steepening and that the demand is actually going even higher. So it's a real problem that we have finding this copper. And here you really need to understand where copper is coming from. Copper is a metal that is found only in very few locations in the world, in the quantities that we can mine. The term of the geological reserve, we have to look a little bit here at geology and ore deposits because we're dependent on these. The geological reserve is that part of an ore body that you can mine technically and economically. That means it doesn't help me to have a few atoms of copper in the ground. That doesn't make it a mine yet. It needs to be in a concentration that can be mined economically. And here the problem occurs that the average copper content in global ores, that are all the mines in the world that are being mined, over the last 20 years or so, has come down from around 1.5% copper per ton to now below 1% copper. That means we had a the copper content, average copper content, fell by over 40% over the last 20 years. And that means, of course, let's for simplicity, let's say the ore content falls from 1% to 0.5% in all the mines that we can mine globally. Then it means that in order to mine the same amount of copper, to get the same amount of copper, you need to mine twice as much ore. You need to actually, instead of 1 ton of ore, you need to mine 2 tons of copper ore in order to get the same amount of copper. And that's a similar problem we saw in the previous slides on oil. The amount that I find and the amount of commodities that we see in these deposits is getting less. The problem here is that the next generation of mines, where we still have a lot of ore, are sitting in deposits in South America, for example. Peru and Chile have around 50% of the total known ore deposits in copper. The other deposits are in Zambia, they're in Congo. There are very few in Asia. And that means, of course, we need to go into countries now where we have a high political risk, partly. Both Chile and Peru have last year voted socialistic governments, which want partly to nationalize the mines. No mining company from Australia or Canada or US will invest a few $1 billion to build a new mine if they don't know what their internal rate of return is or what their return in general is. So there needs to be security. It's not about that the taxes might go up a little bit or the royalties go up. It's insecurity that I have. But you also see from this dynamics here that we need higher commodity prices. We need higher copper prices in order for these deposits to become economically mineable. And that's our point about commodity prices. Currently, the copper price is sitting at $4.20 per pound. You can express a copper price or base metal prices in generally either in dollar per ton or in dollar per pound, per English pound. We generally look at dollar per pound because that's the Anglo-American system. So we're just under $10,000 per ton if you look at dollar per tons. This is one of the biggest problems. Very often when I lecture to my students, I ask them, so what's the biggest driver for commodity prices? And they say it's electricity or it's wages or it's fuel for the trucks. The biggest driver for commodity prices over the last decades were falling grades. Yeah, so and in order to mine the same amount of copper, I have to mine more, and that makes it expensive. The problem we see in copper, we have basically in every base metal. And my colleague from Goldman Sachs, Jeffrey Curry, a few weeks ago, he gave an interview in the Financial Times, and he said, rightly so, we are basically out of everything. We're really out of all important commodities. You see here copper, lithium you need for cars, cobalt that you need for cars, and so on. And these 2 lines here, you see at the bottom, you see the definition. You see STEPS, steps. That's a stated policy scenario based on existing and announced policies. And the Sustainable Development Goal scenarios, you're all familiar with the SDGs and so on. That's shown here in red. And in green, you see the production, what's under construction. Very few mines are currently under construction, but these mines will be empty quite soon. And they're going down here, a little bit better by lithium. I think we have quite a bit of lithium still on this planet, but cobalt and copper could be quite difficult. So mines the gap. This is something to consider, and that's why we say that we're looking at a new megatrend. The new megatrend is energy and commodity security. We hope that the energy transition will take place, but I think it's going more about security over the next years than anything else. I think the Ukraine crisis only has emphasized this problem, but we had this situation also before that. This is another metal, platinum. Those of you who are looking a little bit at the discussion between lithium batteries and fuel cells, there's a huge discussion going on in technical circles. Are we going towards a lithium battery or are we going to the fuel cells? Unfortunately, I don't have that picture on here in this presentation. Now, I was invited to Anglo American's launch of the first fuel cell truck used on a mine last week. I went down to, actually 2 weeks ago, it is now already. I was down in South Africa and they launched a truck which could carry 290 tons of ore and was driven by a fuel cell. So those of you are interested, I got some really interesting pictures. It's the first worldwide, the first truck running on fuel cells. So I think fuel cells is becoming an important part of mobilization. And for fuel cells, you need platinum. And so FCVs, that are fuel cell vehicles, that's a global FCV fleet. So these guys here from WPIC, they're predicting that over the next years, we're seeing a sharp increase in fuel cell demand, and that would mean we need more platinum. And I would support that. I think it's not neither nor. I think it's a combination of both. We're going to see the electric vehicle, which is running on lithium batteries, or on top of that, especially for big trucks, you can use fuel cells that use platinum. And this is the other metal that we briefly discussed at the beginning, but it's really becoming crucial now, and that's nickel. Elon Musk last year, you might have followed this discussion, find me nickel mines that can mine commodities sustainable. And that's something here that I want to emphasize here. It's one of the biggest concerns for lithium batteries, because the lithium batteries are so-called NMC batteries, and N stands for nickel, the M stands for mangan, Mn, the metal mangan, and C stands for cobalt. You can't build a Tesla battery or any other electric vehicle battery without nickel. And here we're coming in as investors. I want to use one example why we believe looking at commodities and looking at mining and exploration is becoming so important. And this is an example of a nickel project in North America and the US, which we looked at very early already, and we saw the potential of this deposit. I'm not going to make economic geologists out of you now, but if you recognize early how big such a deposit can be, this is a map view from the top. There's a geophysical method was used to map this magmatic body. It was an intrusion many 100 million years ago. This intrusion came into the Earth's crust, very rich in nickel. Nobody looked at it, but we looked at the geophysical footprint of this deposit. Said, look, once they start drilling outside of these shaded areas here, that's where the economic resource at this stage, the reserve, let's call it reserve, is sitting. That's what the market discounted. But once you go a little bit further, and that's obviously what Elon Musk and his team has done, you see the potential here, and you have a very scarce deposit of a very scarce metal, namely nickel, in a country that's very geopolitically not very risky. And last year he did a takeoff agreement he signed a takeoff agreement with Talon Metals. The share price went up another 30%. That was our entry point in the fund. And this is something to look at currently, to look at how cheap these companies are already. Quickly want to go into the valuation. We built models, financial models. We're not going into the technology of equity valuation today. How do we evaluate commodity equities? But it's DCF analysis that we use mostly in producing mines, discounted cash flow analysis that you are all aware, that you all know how DCF works. And these show the copper prices that are currently discounted by producers copper producers. In other words, that you need to put into your DCF models in order to get to the current share price. Now, the current share, it's fallen a little bit, now it's coming down, but the equity prices came down even further. But it shows the situation really nicely. So if the copper price is $4.75 here, these companies a few weeks back discounted copper prices of only $3.40. Most of them are below $4. That means you had to put in these prices into your DCF models in order to get to the current share price. This is perhaps even more striking, this valuation methodology. It shows you how the Standard & Poor's, how the valuations are here. Everybody talks about bubble territory in the markets. Now, if you look at here, the various sectors, information technology, for example, makes nearly 30% of the Standard & Poor's 500, healthcare 15%, and so on. And these numbers, the small percentages that you see here, besides the big bubbles, is a percentage that application software, for example, makes out of these 27%. Yeah, so that's how these are to rate. Here you see it on the left-hand side, the sector, percentage of S&P 500, industry, percentage of the sector. Now, if you want to look at sectors that are really attractively priced, this is now from 2020, but the situation is looking exactly the same. You look at the materials, which includes mining, and energy, which are the oil producers. So materials, the mining companies that are included in materials, make 2.56%. 2.56% of the total Standard & Poor's 500 are the mining companies. Of these 2.5%, just 8% are gold. Commodity chemicals, which is, for example, cyanides that you need, construction materials, copper producers, 2.7% out of 2.56% are only this really important metal. If you look at value in the market, this is what you should look at. We're in a mega trend. If you accept we're moving into a new mega trend, these are the sectors that haven't seen any significant increase yet, any value appreciation. Same with energy, oil producers, whether it's exploration or the producers. Yes, the 51% of the energy are the big producers, but that's only out of 2.5%. So real undervaluation. You see how attractively these companies are produced. This morning we looked at the dividend yields that are getting spit out. All these energy producers, with very few exceptions, have double-digit dividend yields. Some companies, if you include share buyback, have 20% and more. Same. These are the valuations in the oil sector that you have. The significant underperformance of the energy sector of the oil companies, of course, partly to a large part being driven by the ESG and the sustainability strategies out of fossil fuels, that there are very few friends for oil. That has changed now due to the Ukraine crisis, and we're going to see it's not about energy transition. It's really about going forward. It's about energy security, whether we like it or not. But oil and gas will play a major part for us going forward. So the oil sector currently, we are at this morning we were at $115 per barrel. If you take a DCF model again, you put in oil prices of $56 in order to get to current equity prices. Free cash flow at an all-time high. I've never seen the sector being so attractively valued. And that brings us to gold, and the metal that's really the safe haven if you want to protect yourself against inflation. And it's I must say, for somebody who's worked in the gold industry for many years, worked in the two deepest mine in the world, and knows how difficult it is to get an ounce of gold out of the ground, the gold price has been disappointing over the last year, especially after considering the current inflation that we see. Now, it's not about the nominal interest, it's the real interest. We're deep into negative territory in terms of real rates. I think the best explanation I can give you on gold is it's a strong US dollar. There's of course an inverse correlation between US dollar and commodity prices. Commodity prices, including gold and silver, are nominated in US dollar. When the dollar goes strong, commodity prices go weak because the demand is coming under pressure. But it is disappointing. We believe gold is also looking for a revival. And so are gold shares. So this is the TSX, the Toronto Stock Exchange, against the US dollar gold price, a ratio. It's rock bottom. I've never seen also gold shares being so cheap. That's what's depicted here, that's shown here. But there is one word of caution, and that's a study that we do every quarter for the gold industry. That's an internal study from us where we take the 18 biggest gold producers and we calculate the free cash flow break-even price. That means we calculate the average gold price at which the mining industry is not, the gold mining industry is not making a single dollar of cash, therefore also wouldn't pay taxes. And we include here, just briefly to go through these bars, the cash costs. So this is the wages, electricity costs, the kipper, the truck on the mines and all that. So that's what you put in order to produce an ounce of gold. That's very often this blue bar. That's what presented by mining companies. They say, oh, we only produce at $790 per ounce. Therefore, our margin at $1,800 would be then $1,100, $1,200 per ounce. But that's wrong, because a big part of the mining industry, also oil industry, is the capex. You need, for every ounce that you produce in order to stay in life, you have to find somewhere another ounce again. You have to build a mine. You have to explore. And that's this red bar here. That's the capital costs. $450 in average for this year, what we estimate. Last year, the average production cost was $763 per ounce. On top of that, $453 per ounce. A little bit of exploration. That's the drilling rigs that you put down in Burkina Faso or in Congo or in South America, wherever you're exploring. That's a green one. And the the G&A is the purple bar. This little bit of finance cost, the interest that you still pay, that's been falling away largely now because of the companies could fix their balance sheets. So we're sitting here at around currently $1,400 per ounce, all in free cash flow costs. And at $1,800, you see the margins that you have here. But, and this is a big word of caution that we currently have as asset managers, as portfolio managers in the equity space, have to watch carefully. We see huge inflation here. And if the gold price doesn't go up in the future, the margins will contract here. We saw that we had a miserable quarter for the mining industry, but especially for the gold industry. What sometimes helps is going into early stage projects. And that's our speciality. Looking at companies that are not yet producing. I'm not going to detail here in the geology. That was some of you who might follow the gold space. That was the takeover of Great Bear Resources by Kinross last year. We had calculated here. We had calculated a takeover price of $28. They were taken over at $29. And what we've done here, that's a deposit in Canada. We really took a very detailed geological look at this and discounted all the ore that hasn't been, the gold ore that hasn't been drilled yet, but where we understand the structure. I think it's in the current high inflation environment, because these companies don't have huge expenditure yet. They don't produce yet. So therefore the oil price, the diesel that you need to feed your trucks with and so on in your mines doesn't come into play here. So they're less exposed to inflation. It's a study as we still have to undertake whether these juniors perhaps perform even better than the producers. But yeah, it's an interesting angle that we use here. So that's I've come to my end. I'm over 2 minutes here, I think already. Ukraine crisis very clearly has increased the focus on energy security and commodity security. Fossil fuels and renewables are both needed in the future. That's what I believe. Fossil fuels are overseen, incredibly attractively valued. I think of all the sectors, the energy producers, fossil fuels producers are the most attractive ones currently, and we're going to need them. One can ask, are the energy goals that we want to achieve over the next 20, 30 years achievable? From what we see, it will be very, very, very difficult. Enormous bottlenecks in raw material supply. I think that's very clear. It's very difficult to find all those commodities that we need. Inflation is a concern, and commodities generally are a hedge against inflation. The question whether you want equities or maybe buy the gold bar or the silver bar. There are exchange ETCs, exchange traded commodities, which invest directly in commodities. All these have huge inflows currently. But if you like equities, the valuations that we currently see are at a historic low. I've never seen in the industry now for 35 years. I've never seen such low valuation, whether it's gold, silver, industrial metals, or oil. We're currently in a correction phase, but I think there's a lot of upwards pressure on these. And then ESG, it's a very, very important topic. That's I touched on it today. But we developed, as Martin said earlier, we developed our own approach, which won many rewards. It's based on the MBA thesis of my wife, who won a few prizes for her tool that she developed at Strathclyde University in Glasgow. And mining companies need to mine. They need to operate sustainable. And we're looking at that very much in detail. And ESG investors, sustainable investors or ESG focused investors have started now looking at mining. Especially also the EU recognizes we need these critical raw materials, and it's becoming also a big part for these guys. With that, I come to the end of my discussions here and hand over to Martin. Perhaps there are a few questions.
Thank you very much, Joachim. It was a really great presentation. It was a pleasure to hear your thoughts on the topic of commodities. I would like to open the Q&A session right now. So if you have a question, please raise your hand, turn on your camera, or post the question to the chat. Okay, Martin, please go ahead.
Yeah, hi, Martin here. Thank you, Joachim, for a very interesting presentation. I would have one question, and that is, how do you look at crypto and the impact of crypto on the valuation? Is it something that's bringing the price levels to the fundamental levels where the economic value is justifiable and fair, or you think that like everybody else, that this is a bubble that is like very ESG intensive, and then it's basically only contributing to higher inefficiencies in pricing?
Yeah, of course, gold and crypto is of course on two sides of the pole of the world. So if you either believe in gold, solid asset, tangible asset, or crypto, which is based on algorithms, is built. And I'm not a crypto fan. Sorry, I'm not a crypto expert. We're sitting here where I live in Zug in Switzerland in Crypto Valley. So I speak to a lot of crypto fans and companies which are doing crypto. You have seen over the last week what a bad hedge cryptocurrencies are against inflation. It was like even stable coin was presumed to be a strong hedge against inflation. My personal opinion, I emphasize I'm not an expert here. It's an asset class which has not proven itself yet. It's very new. On the other side, gold and commodities we use since the beginning of mankind. Gold is over 5,000 years used as a currency. So although gold also didn't do so well, I think I would stay with the proven asset class, which are the commodities, and especially gold and silver. The one point that you touched on is the energy intensity that you have, to produce always the net, to calculate basically the next coin. And this is something we need to look at. If you believe in the scarcity of energy, the energy demand from crypto is becoming incredibly high. And from that point of view, I would urge everybody, including regulators, to look closely at this. I think they're already not allowed in China. Cryptocurrencies, trading cryptocurrencies, I think is forbidden. So I think there are significant hurdles, especially now in this current environment of inflation, where there will be a lot of headwinds towards crypto. But I think time will tell whether it's coming in. I'm quite honestly, I'm quite tempted to buy my first Bitcoin in this environment and being so low. So just to try it out. But there are fans. But I'm quite. I would say I'm quite critical towards this asset class, especially also, as you mentioned rightly, the energy demand.
Right. Thank you. I was just, maybe putting it into context of the valuation, because I mean, for years, like you mentioned, gold was perceived as an inflation hedge and some kind of a store of value. This view has been kind of dislocated about the emergence of crypto, because a lot of money just went into crypto. And then
yes.
My question was specifically, what do you think if it's really now what we're looking at in commodity and especially gold environment? Is this the really like economic value, the fundamental picture, that the real use of this commodity in industry? Because we have removed this element of inflation hedging and everything with Bretton Woods is no longer a system, and we're just moving somewhere else.
Yes.
So that was specifically what I was because.
Okay, is the gold still a hedge? Does it still have a place? Well, if you've bought gold in 2001 at $265 per ounce, then I don't think there were very many asset classes where you would have gained so much. It's really shot the lights out there. Not talking about the equities now, the gold equities. I think I would like to say gold is a safe haven storage, but you're of course right. It's so volatile and it has been disappointing. Do we move into a new time where gold is not an inflation hedge anymore? Perhaps it's too early to say that, but I think you see where we're also coming from. It's if you had invested back in the 60s or until Nixon actually opened or stopped the gold standard in 71. Until then, the gold price was fixed at $35 per ounce. Yeah, and that means that gold could be produced below $35, of course. Otherwise, you couldn't put the gold standard at $35. So imagine now today the gold standard were still at $35. Then we wouldn't produce a single ounce of gold worldwide, and it would be a huge scarcity. So you always need to look at where's the gold price going in terms of where's the production cost, the total cost going. And that's what I tried to show you here in this presentation also. Your commodity price is always a function on the costs you need to put in order to get that ton of metal or that ounce of precious metal out of the ground. So when I worked in the South African gold industry, we mined gold. All-in cost was $300 per ounce. Yeah, that was, for me, it feels like yesterday. It was end of the 90s. So now, just over 20 years later, we mine gold, you saw the slide, at $1,400. And if you keep that in mind, it's one additional force for the gold price to move up in the longer term. Not in the short term, I agree. So you need a long breath. You need to be able to look at volatility. I believe, quite honestly, a certain amount of gold is healthy in the portfolio. But perhaps a better metal is silver, Because with silver is always a small brother, but with this energy transition now, you need for square kilometer of solar cells, we didn't touch on that yet on the technical side of silver, for 1 square kilometer of solar cells, you need 11 tons of silver because of the conductivity of the physical properties of silver. You can't use copper for that. And here comes a totally new aspect around the technical demand that's coming in for precious metals. Platinum we discussed, palladium we discussed. Gold doesn't have that. Gold has very little technical demand. So if you are right, and I'm not saying you are wrong, but if you're right, that's a story for gold is over. Put a little bit of money into silver then, because there's a real demand outbreak coming.
Thank you. This is very helpful. Thank you for your views.
Thanks, Martin.
Thank you very much. We have 3 more questions. We have a little bit of time. If you can shortly answer that.
Sure.
It's in the chat. Would you like me to read them for you?
Yes, I don't see. Where's the chat? I don't see. Ah, here, hang on. Let me open that. Okay. Why do you think the valuation of materials equities is so low when we all see the demand curves? Thank you for a great presentation. Well, it's really not everybody sees that, because we are currently, I mean, every new innovation, every new trend is following an S-curve. Yeah, whether it was the combustion engine, whether it was the PC. Yeah, it started low and it went up, and you see the forecasts by people like Mars. You see the forecast by the EU. I'm part of that critical raw material group that the EU in Brussels that started, and they asked me to. They want to find these critical raw materials within the European continent. It's not there. I can tell you as a geologist that what we need is not there. But it's still generally investors have a horizon. And I'm speaking here as a fund manager and an investor, that if you're lucky, they have a horizon of 3 months. Yeah, that's how far they look. Everything beyond that is they're losing money in an equity. We saw that just now. They're getting out. They don't look what's happening. If you are focused by the fundamentals, what we're seeing here, you should look into that. And I've just came back from 2 weeks roadshow through Europe. It starts getting there. We see for the first time, we're seeing interest again. But you're absolutely right. We're right at the bottom of the valuation. And this mega trend, which I like to forecast that we're going in here, is just starting. Everybody, for many, many years, people have been focused on the media sector, on the IT sector, Apple, Tesla, all that. It's a trend. You see the masses going there. Mining has also had 10 very bad years. It's really since 2012 when China fell off the cliff with its growth rate, and since then it was really tough. And I tell you, as somebody who's working in the commodity industry for many years, we had a bloody tough decade. It's only since 2 years that we slowly recovering. So what you observe is right for the moment, but going forward, and you want to plan ahead, this is a sector that will grow. So that was, sorry, it was a little bit longer than short, Martin. Apologies, but that was the answer from my side. Oh, sorry, then the next question here. How do you see the role of recycling? Very good question for the metals, not just mining the new limited water. Yeah, very, very important part is recycling. You see in copper, for example, between 25 and 30% of all copper is recycled. In platinum, up to 40% of the platinum is recycled that we need. But this is a source that we need in order to fill the demand. Copper always will be recycled. When the copper price go up a little bit, then a little bit more, then we probably close up maybe to 30, 33, 34% recycling. And if copper prices are low, it's less. But going forward with a high demand, we're going to see the demand side to increase so quickly that recycling can't fill that gap. Platinum, I'm not sure yet. We need to see how fuel cells are developing. It probably takes still some years until we see the demand outstripping the recycling part, or the part that recycling has an effort on it. But we see partly recycling everywhere, of course. But if we look at the demand side, I think demand side is accelerating so much that recycling cannot fill that gap because so much is going built also into infrastructure. But you could hold this whole lecture just on the recycling side. Sorry, then the next one here. Do you find energy, mainly oil, gas, European equities investable given the risk associated with a conflict between Russia and Ukraine, or would you rather stay with US energy equities? Another excellent question. Thank you for that. We're focused on mostly on the North American. So it's not only US, especially also Canadian and companies that produce in South America. We have some of our biggest investments, for example, are in Colombia, explorers and producers in Colombia. I think you can go into the North Sea. I find the valuation, from a valuation side, the North Sea and the UK listed companies a little bit more demanding, with a few exceptions. We have 2 or 3 companies that are operating in the North Sea, but purely from valuation side, it's not the Ukraine. We wouldn't invest we never invested in a Russian oil company, but generally we find the North American companies also in terms of dividend payouts. It's never been a focus for us, but dividends are suddenly a performance driver in our funds. Yeah, we were never looking really at dividends, and suddenly if you have 20% return from dividend payouts and share buyback, this is becoming a performance driver here. So you need to look for us as stock picker. That's what we are. We are really looking at individual investment. We have 2 excellent oil analysts in our team. But generally, I would say the North American are offering more value. I see there's some more, Martin. Shall we look at these questions still, or you want?
Yes, please go ahead. I see big interest in the topic. So if you don't mind, people are staying. I see that they are still here, so I will not, revoke their right to ask question. So please go ahead. Okay. We had questions from chat. Let's switch to the question from audience. Alexander, please go ahead.
Okay.
Thank you, Joachim. Great presentation. Thank you very much.
Thank you.
Quick question. How do you, like, from the modeling perspective purely, I'm wondering, how do you take into account the fact that basically when you typically model something through the DCF model, as you mentioned, you will take into account purely like financial or economical factors, right? But these days, and I think the conflict in Ukraine has underlined it, there is a lot of political factors affecting basically the decisions, the demand, the supply. How do you, in your models, how do you try to take into account those factors?
Yeah,
thank you,
guys. Really good questions here today. So, of course, whether you mine in North America or whether you mine in Chile or in Burkina Faso, is a very different issue in terms of risk. Generally, you can adjust this by the discount rate. So we're trained, me and my team trained by the North American markets. That's where the most liquidity is. So we generally take for producer, don't ask me whether that's right or not, but it's what the market is doing, is 5% for a gold stock. In real terms, 5%. We take 8% for base metal stock and take 10% for an oil stock. Whether this is right or not, I don't want to go into that discussion here today. But what we do in our portfolio, we don't know. And for example, the biggest future gold deposits you have in West Africa, in Burkina Faso, Ghana, Guinea, and Ivory Coast, and we need to look at these deposits if we want to have future gold production. So, but I don't want to put 8% of a stock in my portfolio then. So we limit normally the exposure to these risky countries by weighting. I said I can't. You could use the discount rate. Yeah, so you could say, oh, gee, it's so risky, so if we take 15% discount rate for a developer in Burkina Faso. But then you might still get such a high valuation gap that you say, ooh, there's so much value in this stock, so I put 7 or 8% in there, despite you using a high discount rate. But there's a reason for this low valuation. Very often, that's what we hope to find. It's because the market doesn't realize yet the technical, the geological upside. But sometimes it's really the risk that you have. And good examples are the copper developers in South America. We look at one company now, for example, which is having a world-class deposit at the border in 3,500 meters altitude, though, between Chile and Argentina. And what do you do now here? Do you put a high discount rate on it, and still that deposit would have an upside of 80–90%, or do you just reduce the exposure? And what we do is we either reduce the exposure to the fund to 2%. So if you go below 2% in an equity, it doesn't move the needle. So you should have probably 2% of a company in your equity portfolio. We have very tight portfolios, maximum 45 stocks. But it is a very valid question, which we need to look at time to time. Very important here also the quality of the management. Yeah, we really only invest in companies where we have management teams with good track record. That becomes absolutely crucial for us. So you really need to look individually, but geographically, you're absolutely right. There's a huge often, and it gets more risky. It's unfortunately, because the next big copper deposit will be in Congo. Yeah, that's where Ivanhoe Mines is mining. So yeah, but it's an interesting topic.
Thank you.
Okay, let's switch back to the chat. We have the last question.
Okay, I see it two more. So for how much investment debt do you assume, given that almost all oil and gas companies reduce exploration capex roughly 50% in recent years, now still hesitate to fully invest and preferring shareholder returns? How much more investments do we need in order to catch up? Well, there are two questions really. How much do they have really debt to take on? Currently at these cash flow levels, you saw the discount, the oil price they're discounting, they don't have to take debt. Yeah, for the big projects, perhaps maybe the big companies have to take on some debt, but generally the companies now can finance the exploration and investment programs out of their own cash flow, and it's very different to 10 years ago when the fracking industry in North America started, which, by the way, it's a technical revolution. Purely from the technical geological side, fracking is an incredible thing. But there, they just put money in and spit it out as dividends again at the end, and that's where fixed income funds, for example, started looking at the fracking and oil industry. But how much more investments do we need? I can't tell you that. It's you saw from all the discussions we have, we're going to see maybe one number that's interesting. Since I follow the oil sector, since we started the funds in 2006, we were back in 2006, the oil demand was at 84.5 million barrels per day. That was the global oil demand. We're sitting today now, we're sitting at 101 million barrels per day. It was back in 2019, fourth quarter 2019, before COVID. Global oil demand hit for the first time 100 million barrels. That means basically you can say per year, the daily oil demand increases by 1 million barrels. OPEC currently, OPEC Plus, has spare capacity, lowest ever, of 1.6 million barrels per day. That's if they opened all the wells, they could add another 1.6 million barrels. So how much investment do we need? Because you saw the low-hanging fruits are gone down. We need billions. We need so much investment has to be done. That's hopefully we can move away from oil and go into mining and renewable energy. The problem here is that from the first borehole you put into a mine, into a copper or nickel mine, until you start producing, you need 16 years in average. Yeah, until you have the licensing, you have explored the whole thing, you build the mine. So even if you would double the copper price tomorrow or the nickel price, you wouldn't produce 1 ton of copper or nickel more, because the facilities, the mines are simply not there. That's in very short an answer to your question. Then I got the last one here. How do you see the role of nuclear energy in the overall energy mix, especially the role of new generation nuclear power plants? Yeah, these are modular plants and so on. TerraPower is mentioned here. Yeah, I'm very optimistic globally that nuclear will play a big part. Currently, don't nail me down on the number, it's around 8-9% of global energy supply is coming from nuclear, especially here in Europe, especially Germany and Austria. I think these are the countries which are still explicitly against nuclear power. There's resistance again, but on a global basis, especially also France, England, all that you know, nuclear will play a big part. And these that you mentioned, the new generation, these modular plants, which also really safe, are which you also could use on a small operation. We had a few weeks ago with a mining company putting these modular nuclear plants in a mining site where you don't have access to the grid. So I see this as developing. It's part of the whole energy mix. And if you look at the CO2 emission also, I mean, Germany has it's one of the highest per capita CO2 emissions worldwide, because it's got 3 days after Fukushima, they got out of nuclear power, decided to be getting out of nuclear power. They're dependent on lignite and on coal. And so I think part of the whole ESG mix, and I know it's a question which is has a lot of pros and cons. Where do you deposit that stuff in the end? It will always question. I don't have an answer to that, but I think we need nuclear energy as part of the whole mix. And you're going to need fossil fuels, gas, you need coal, probably you need the renewable energies, the more the better, but for that you need copper and the other metals, and probably also nuclear energy. It's getting very, very tight going forward, and we need to look at that carefully. And maybe that's a good sentence to stop the discussion. And I want to hand over to Martin there for the final words.
Thank you very much, Joachim, for the really answering the question in full. I would like to thank all attendees so they found their time during the day and listen to one of the presentations that we organized for them. I don't have any updates on the next event that will be online or in person. We have the only CFA Society beer, which will be the May 31st. You already received the email, so I'm really looking forward to seeing you. And pretty much this is the over of our event season, which was very rich and really knowledgeable. So thank you very much, Joachim, to adding
Thank you.
Your part. And I will see you in September, on October, on our events or at our events in person or online. Thank you very much. Have a great summer. Bye-bye.
Thank you very much. Thank you.